In this video, I'm going to talk about Countryside Properties, give my views on this London Stock Exchange listed United Kingdom stock, and answer the question of whether you should buy CSP right now. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please see a licensed professional. Don't forget to drop your suggestions in the comment section down below. This is my second time recording this because the microphone bugged, so please also drop me one of these for the YouTube algorithm. Thank you. Countryside Properties, formerly known as Hack Plimco, are a house builder and urban regeneration partner in the United Kingdom. So they operate by specialising in housing regeneration, effectively looking at places that are deteriorating in the natural decline, such as the change in industry, such as typically the inner city. So they aim to reverse the decline, build on these properties, make them look nicer and add value to the area. Or they also operate as a house builder, in which they operate with large scale building sites located in the southeast of England or London, and they provide affordable housing whilst doing so. They currently have a market capitalisation of £1.7 billion and have roughly 1,836 full-time employees. When first looking at a stock, I like to look at the price to earnings ratio, but this isn't just to value it. I like to see what it says about investor sentiment. Typically, the lower the price to earnings of the stock, the lower the investor sentiment. Currently, CSP has a price to earnings ratio of 9.9 times, which is lower than the industry of 12.7 times and the market of 17.2 times. This suggests to me that investors have priced in a lot of risks, and this also suggests that they believe that this stock will underperform the general market. However, we can't use this as a definite answer, so I'm also going to look at PEG ratios, which are price to earnings growth. It's basically price to earnings divided by earnings growth. And this, you can see, is trading a forward growth of 0.3 times, effectively saying that this stock is very undervalued considering its growth potential. Although there is rarely a time in which a stock is fairly valued on the stock market, and so everything changes at all times. But at the moment, I could see this as being fairly undervalued. Despite this, when comparing the market cap of CSP to their net assets, it does suggest they are overvalued, although not by much, which I hope that this emphasizes that you shouldn't just use these metrics to value a company, but rather use it as part of your whole research to decide on whether you should actually buy this company and what you think is a fair intrinsic value. So is Countryside Properties undervalued? Well, I would consider the whole of the house building industry to be very undervalued. This is because a lot of risk factors are priced in. There's a lot of uncertainty on our economy, compounded with the uncertainty of the pandemic, and also the uncertainty of Brexit. Will there be a deal? Will there not be a deal? Typically, an undervalued stock can have high volatility. Countryside Properties ticks this box, and also usually lower investor sentiment from it. This doesn't mean, however, that this can't suddenly become more reliable, traded higher and have higher investor sentiment, although that would be a transition over the medium to long term. So therefore, before accurately valuing the company, I feel that I need to see how well they can generate returns. Firstly, they were able to generate an impressive return on equity of 16.6%, which doubles their industry of 8.3%, suggesting to me that the quality of the management could be higher, or that the business is in a well-placed position to outcompete their peers in the industry. I personally like to look at how well a company is positioned in generating returns on their capital, or cash basically. And ideally, I look for a return on capital employed of over 10%. With my portfolio and the current weightings, I have a return on capital employed of 30.5%. So there is a lot that must tick my boxes. Countryside Properties, however, in the latest half year, a return on capital employed of 25.8%, which is very good as they're effectively able to make a significant chunk from their capital employed. And during this period, the country was in lockdown, so a lot of the building sites were actually shut. And so it really shows how resilient this industry is, and subsequently the company. However, some of these metrics can be skewed by high debt loads. Is this the case? Is their debt a risk to the company? In fact, Countryside Properties has a great but not excellent balance sheet. Their short-term assets do outweigh their short-term liabilities and their long-term liabilities combined. They don't have too many long-term assets, although it's not a massive problem. However, my concern is with their debt levels, and currently their debt levels are quite high. You may see a debt-to-equity ratio of 33.5% and think, well, that's actually quite low, but it's high compared to what it usually is. In the last 4 to 3 years, they have had a debt-to-equity ratio of less than 7%, and at some points even being debt-free, although currently it's trading at a much higher thing, and that was likely to raise cash because of the pandemic and the uncertainty around it. And in fact, they had actually had a share dilution in which they had released nearly 73 million shares at a share price of £3.35 per share. The share pool had been diluted by 16.5%, effectively meaning that if you were a shareholder before this time, that a lot of your shares lost value as there is a greater supply and therefore a lower demand for each individual share. But this could be concerning for shareholders as their level of risk has subsequently increased due to the higher debt. But this is also a massive concern when considering that their debt is not covered by their cash flow. Which brings to me their earnings. In the last 5 years, they've managed to generate an earnings growth on average every year of 31.5%, which is excellent and is honestly one of the top performing companies that I've seen in the FTSE markets. However, they also have negative cash flow, and to a beginner that may be quite confusing. This is because a beginner may think, well, if you have a profitable company but negative cash flow, how does this add up? Well, it's dependent on when they receive their money. For instance, they may have to pay the bills before, or the liabilities before receiving their payments. This is furthermore impacted by perhaps people were uncertain during the pandemic and had withdrawn their cash in ideas so that they could hope to build up their own emergency fund because they themselves are at risk. And so this has probably meant that in the short to medium term, they will have negative cash flow. However, since raising capital and the balance sheet was already very strong, it does put them in a strong spot. And when they had raised capital, it does also give me the idea that perhaps they're looking to acquire land at cheaper prices. But because of the negative cash flow, does this mean that their dividend payments are at risk? Well, unfortunately, their dividend was at risk and was subsequently cut/suspended. This meant that their dividend that typically paid in February and July each year had been cut. It typically yielded around 3% and had only had a track record of the last 4 years. However, it did have an impressive growth rate. I'm not going to calculate the compound annual growth rate, but if you look in 2017, they had a dividend payment of 8.4 pence, and in 2019 that was 16.3 pence. So this shows that if it's sustainable and they can keep up with their rapid growth, that they could also grow their dividend. In the last 3 years, if you'd have owned this stock, however, you would have only gotten returns of 7.2%. Yes, it beats the industry. Yes, it beats the market. But it's not the amazing performance that I look for in a company and their stock price. However, we also need to account that they are priced in heavily at the moment, and they are down something like 40% year to date. The concern I have, however, is their private sales, and the fact that 50% of them are from first-time home buyers, and subsequently those that use a Help to Buy scheme also total 17%. From my personal and therefore lack of experience, I've noticed that house builders tend to up the valuations of their newly built houses so that these first-time buyers who maybe don't have as much experience in valuating a house and buying a good property may pay more for it. And what typically happens is that they'll pay $260,000 for this mediocre quality house, and then it will be valued after they've purchased it for around $180,000. They've lost a significant amount of equity and can even put them in negative equity. And so it is seen quite commonplace in the UK that some of the house builders are fairly corrupt, especially when you consider that the whole supply and demand issue, where there is so much for demand but little supply, they can easily ramp prices up and get away with it. So the only way to really look at how well they are performing is by looking at their customer satisfaction, in which the Home Building Federation has actually fairly valued them at 5-star rating, which means 91% of those reviewing it were happy. However, I do not know how easy it would be to manipulate these figures, and therefore I can't fairly judge this just in case they are, for instance, buying out the Home Building Federation. An example of this would be in the housing crisis of 2007. So what do I think of Countryside Properties stock, and is this a stock you should buy right now and add to your portfolios? Currently, I feel that the housing market is under a lot of pressure. Houses are rising everywhere except London. They're pretty much hitting all-time highs. And there's also the uncertainty around Brexit. Will we have a deal? Will we not? That combined with the economy worries does worry me, as the housing market is very closely tied to the economy and subsequently is priced down a lot. In my personal opinion, I feel that Countryside Properties is in a better position than some but not all house builders, as they have diversified revenue and partnerships, meaning that they will have a consistent revenue stream during this time of uncertainty, or perhaps where people aren't buying new houses. This is because the urban regeneration schemes and partnerships means that they will be getting contracts from local authorities and hopefully making at least some of their revenue. This is also combined with the fact that they do have an order book of £1.5 billion value. And so they should be okay, but then also the order book isn't guaranteed. These clients can cancel at any given point. And with their focus and strategy on their employees, partners, and customers, they really have found a way to be efficient in the company. They are regularly calling up on their customers, now making use of the new technology infrastructure that they had installed to show clients houses using videos, and also communicating with customers using video chats like Zoom. I feel that this should improve their efficiency going forward and therefore give them more of a clear-cut growth path, especially because they're in the house building industry, which in the next 10 years is likely going to have a high demand, if not longer. I personally, however, will not be adding them to my portfolio. This is because I'm not that interested in the housing market currently. I think there are a lot of risks priced in, and I'm very bullish on Brexit and the economy, but I do not feel that this is where I should put my money, as there are better companies elsewhere. Regardless, if you're looking for a company that you can add to your portfolio, that you diversify into, that I would consider to be undervalued with high growth potential, then Countryside Property stock might be for you. They're currently trading of around £3.35 per share. I would say that's a fair value, and they are priced down a lot. Some good news, and they may be priced upwards. Although, considering it, I would probably just average in slowly. I would not buy a lump sum now, as there could be more negative news to come before we hear about any good news. But the one thing they do have on their advantage is that when the economy is doing well, house builders will do very well. If you're interested in my National Express stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.